conversation with Dharmakirti Joshi, Chief Economist at CRISIL. Mr. Joshi, thank you so much for taking time out for us.
Glad to be here.
So, while we're waiting for the inflation figures to come in, what is your expectation from today's figures, sir?
Well, our expectation was around 4%, I think, and I think it could be lower than that, but we have based our expectation on the basis of some data that came out.
Okay.
There is a lot of data about which we don't know.
Right, okay. So we have figures for July IIP that's come in at 4.8% and CPI inflation has come in at 3.65%. So not too far from expectations. While we're waiting for more details on the figures, that's the headline. Broadly in line with expectations, right?
Yeah, I think it seems to be somewhere between what the market was expecting or the consensus estimate were and what we were expecting. So I think a couple of basis points here and there don't make a difference. The main point is, as you were pointing out, I think for the 2 months we have seen inflation below 4%, and the average for the second quarter is now likely to be around 4%. I think that is our expectation. So don't forget that there is a base effect at play. But the decline in inflation has been much higher than what is dictated by the base effect. And as you have said, there is some sequential softening, particularly in the food grain segment. I think the rice inflation, the wheat inflation, the data was showing that it is coming down, and some softening in pulses also. Within vegetables, I think, which is the main headache right now, I think we have 3 vegetables in the top category: tomato, onion, and potato. The data from Consumer Affairs Ministry was showing that the tomato prices are coming down, inflation is coming down, whereas potato and onions remain high. So there is a mixed trend within vegetables also. But overall, some good news, because the expectation on inflation has been belied on the right side. I mean, so we're getting lower inflation than what was expected.
Absolutely. Let's quickly go through some of the internals here as well. So inflation in cereals and products has come in at 7.3%, whereas inflation in meat and fish has come in at 4.3%. For eggs, we're looking at a figure of 7.1%, and for milk, it's come in at about 3%. Oils and fats continues to contract. It's at about a contraction of about 1%, a tad lower than that actually. And for vegetables, critically, we're looking at an inflation figure of 10.7%. That's important. That was one of the internals we were watching out for. So vegetables inflation has come in at 10.7%. Pulses and products has come in at 13.6%. Inflation in fruits has come in at 6.5%. Now we're also looking at inflation in food and beverages, which has come in at 5.3%. So these are some of the key internals. Before we proceed, Mr. Joshi, again, here also, even in the internals, given what vegetables inflation has been, or what inflation in cereals and pulses has been, again, not too much of a surprise there, and broadly in line with expectations there as well, right?
Yeah, I think, see, the base effect plays out in the month of July and August. July it was the maximum. August, it was somewhat lower. After, I think, August, the vegetable inflation had started coming off the very high what it experienced last year. So I think that is one explanation for this, and this was largely expected. But do remember that in terms of year-on-year inflation, vegetable inflation was close to 30%, I think 1 or 2 months back, and now it is down to 10%. Once the base effect wears off, I think it might go up again. That is why I think the 4% inflation, although it is at what the central bank is targeting, this is transitory decline in inflation as of now.
Okay, so going forward, like you've mentioned, that this decline that we're seeing is transitory. It's likely to see an uptick soon enough, importantly because it's led by the base effect. When is it that we can continue to, once again see an upward trajectory? And also, what I do want to ask you is, currently also for the month of September, there are already some concerns that excessive rainfall might once again pose some risks to several components of the food basket.
Well, I think as far as the food is concerned, the weather has become a key monitorable. It's not only the rains that we are looking at, but also I think the temperature variations. I mean, the year has not been favorable for agriculture as far as the overall temperature is concerned, although from the rainfall side, I think things have been pretty benign. So a mix of these two will determine where the food inflation eventually settles. Our expectation is that monsoons will remain reasonably good, better than last year. And under that assumption, we believe food inflation will come down, and that will be an indication for the central bank to cut rates. But that, I think, as you rightly said, what happens in September is we don't know right now, because the monsoon pattern itself has changed because of climate change. If there is excess rain towards the second half of September or towards the end of September, then the standing crops I think there is something called lodging, the crops actually bend, and that makes harvesting difficult. So all those things could play out. But I think it's beyond my pay grade to be able to predict what's exactly going to happen. So the assumption that we are making is that that will not happen and it will remain normal. But fingers crossed on how the weather behaves.
Okay, all right. So, talking about the monsoons, I do want to quickly squeeze in a question about the figures on the IIP as well. Now, the figures that have come in are for the previous month. They've come in for the month of July. But I do want to ask you, there again, we did see some de-acceleration and some high-frequency indicators in the month of August. In September, too, that's likely to have an impact. Several states, maybe an Andhra Pradesh or a Gujarat or a Telangana, parts of Tamil Nadu or Kerala, we did see some impact on economic activity because of localized flooding there. Is that something that's of concern when we're talking about the IIP going forward?
Well, I think the July numbers first. I think if you see why our prediction was around 5%, and it came in at slightly closer to that because the core part was reasonably healthy. Now, important thing to note is that this is despite the slowdown in some of the consumer segments already visible. I think we are seeing slowdown in the auto sector play out. Even the tractor demand is somewhat weaker. So I think on top of that, what you see is that export actually contracted. So the external and the domestic demand both were not so healthy for manufacturing. Now, what happens in the month of August, I think, will partly depend on how much of government spending has returned into the system, because that is going to be something different from what happened in the first quarter and in the month of July. I think the freak weather events do have an impact on production, but that is transitory. So I would not be too much worried about it. But my worry is, I think, more on how the global economy behaves, because there are some signs of weakening. China is getting weaker. We are also seeing crude prices tumble to close to 70, which is in a way good news for us from the balance of payment side, but also I think not so good news in terms of the global demand going ahead.
Okay, all right. Actually, that does bring me to my next question. We are talking about crude at 70. And while, of course, there are a lot of factors at play, like you mentioned, if there is a decline in oil price, but if that's because of a global slowdown, then the benefit of lower crude oil prices might not be to the extent that we typically tend to anticipate in case of India's economy. But on the current account deficit and also on the inflation front, assuming that we continue to see prices hovering around $70 a barrel, can we expect some further relief on inflation as well?
Yeah, if it happens that way, I think our assumption is that the oil will average around 80 for this year. I think the oil price decline also could be transitory, because if the OPEC, etc., start cutting production, I think then it will again start inching up, because they would also like to align the prices to somewhere close to 80. That's my guess. Unless I think there is a very deep weakening in the global economy, oil prices are likely to lift from these levels.
Okay, all right. And on growth as well, now, while the RBI continues to maintain a forecast of above 7%, we have seen a lot of economists in the private sector expect growth to come in a tad lower. What's your expectation on the growth front? And given all of these factors at play, are lower oil prices expected to provide some upside to the growth outlook as well? And there again, I know it would depend on how the global economy fares as well. Despite a lot of the moving parts, what does it look like as of now?
Yeah, I think it's if you assume that oil prices will remain soft, it will of course provide impetus to growth. It will lower inflation. A lot of items are actually directly linked to the crude prices. I think even if petrol and diesel prices don't come down, there are others like naphtha, fuel oil, air turbine fuel. I think their prices will come down and they will tend to bring inflation down. It's good for balance of payment. So that's a very healthy scenario. But we expect that GDP growth in 24-25 will settle at around 6.8%, slightly lower than what I think the consensus for the economy is. And reason is two things. I mean, one is the rising interest rates will have an impact on the urban part of the economy, not so much on the rural. The interest rate does percolate faster in the urban part and I think there's more credit penetration there, so it impacts. So it's going to have some impact. The second is the fiscal spending by the government is somewhat moderating because there is an acute need to bring the deficits also down. So the fiscal impulse is somewhat lower. I think a mix of these two factors can bring GDP growth down to 6.8%. And this is assuming, I think, that the rains remain normal, agriculture lifts. So despite that, I think but 6.8 is hardly a slowdown. I mean, that is what we believe is our potential rate of growth. So it is slowing down to its potential. I think it was growing somewhat higher than what the potential is, and now it is coming back to the potential. That's how I would look at the moderation in GDP growth from 8.2% to 6.8%.
Okay, all right. So, coming back to inflation, actually, a couple of things that I do want to specifically talk to you about. So, in case of personal care and effects, for instance, inflation has come in at almost about 8%. And would you be able to help explain why the rise that we're seeing there? Because most other components, be it household goods and services or recreation and amusement, they're all seeing inflation at closer to about 2%. So, within that space, personal care and effects at about 8%. Any reasons why?
I think I would need to know what is the component of that. But I think if I were to very broadly relate it to the demand in the economy, if you look at the GDP data also for the first quarter, public administration, defense, and other services. So other services also include personal care and effects. So my sense is the GDP growth in public administration and defense and other services came largely from other services, and I think so there is demand for other services, and which is translating into to higher inflation in other services. But that is a approximate explanation. Once I know what components of these have seen higher inflation, I think then we can better understand why this has gone up.
Sure. Okay. And while we did touch upon the vegetable inflation as well, we're seeing vegetable inflation at about 10%, 10.7% actually. That is higher than the print we had seen in the previous month. But on a sequential basis, we are seeing a little bit of a moderation. So given what we know already about the high frequency prices of key vegetables, potatoes, onions, tomatoes, it's fair to assume that keeping aside what's happening on key vegetables, most other vegetables are actually not seeing a sequential decline. The other vegetables, excluding maybe say tomatoes, we continue to see momentum there. Do you think that's the guess you're taking as well?
Yeah, I think, what we are seeing on the ground is that the potato prices will remain firm. Tomato prices will further come down because new crops are expected to come, particularly from the south. And as far as I think the onions are concerned, actually the prices could go up because the Kharif output is yet to come to the market completely. So all the three key vegetables are not moving in the same direction. I think there are different dynamics. I think potato was impacted by blight, I think, in the potato growing region. So that's a pest. I mean, it's a disease which reduces the productivity in potatoes. So I think that is why we expect potato prices to remain firm for some more time. They may not go up, but they will remain firm. So, and about other vegetables, I think it's at least on visiting the market, I don't see too much decline at the retail level, but I think that's a very small sample. I think I can't extrapolate it to the national level.
Sure, okay. So, shifting focus to monetary policy, and that is something you touched upon as well. We are seeing a sub 4% print for this month as well. And while you did say that that was primarily because of the base effect, and we will see a reversal going forward, what does this mean for monetary policy?
Well, I think the central bank is going to look through this. I think they've already indicated in their monetary policy statements that the decline in food inflation is largely base effect led. But as I said, it's more than the base effect. As you also pointed out, there's a sequential fall in prices. If that sustains, I think then you are building ground for a rate cut, because fuel inflation is deflating. The core inflation is extremely benign. Actually, for the month of July, we found that the non-food inflation was only 2.3%. I think it's very, very low. So the food is the only villain. And if food actually shows signs of coming down sharply and it sustains at that level, don't forget that food generally has a very high base effect in the last 15 months or so. What is playing out in July, August is unusual, but I think in general, the base effect is very strong because food inflation has remained quite high. So if there is sign of that, then I think our assessment is that interest rates could fall as early as October, or central bank could at least show a change in stance, because the global central banks, the systemically important central banks particularly, ECB and Bank of England are already cutting rates, and on top of that, US is now expected to cut rates in September. 25 or 50, we'll come to know pretty soon. So I think there is, from the global side, the scenario is turning somewhat favorable for rate cuts. On the domestic side, because the food inflation has been lower than what was predicted, so there is some hope that I think sequentially the prices are also coming down, and we could settle with lower than expected food inflation. That would be, I think, from the global side and from the domestic side, will create enough grounds for a rate cut. But RBI would play it very cautiously, I would say. I think because
All right. In fact, we just have news coming in. The ECB has cut deposit facility rate by 25 basis points to 3.5%, in line with what was expected. It's also actually cut its growth forecast for every year through 2026. But before we can let you go, Mr. Joshi, one last question for you. We did touch upon some softening that we are seeing in some high-frequency indicators, but we are also in the midst of the festive season now. Given all of that, what is the outlook on the economy for the next few months? Can we expect some fillip to economic activity from festive demand?
I would say so. I think not only from festive demand, but also from government spending. In the first quarter, the government consumption expenditure was, it showed a negative growth, and investment growth actually came down. So the investment growth was largely fueled by the private sector, which is the corporates as well as the households. Households largely, corporates less. So when government also starts coming back and investing, I think you'll see a faster investment momentum. So that is why I said I think the growth will be somewhat better in the coming quarters. And agriculture is also going to be favorable. But overall, I think all said and done, I think we believe 6.8 is a likely outlook for 24-25.
All right, Mr. Joshi, thank you so much for taking time out for us today.